just a minute. So before I go further and talk about the forward rate agreements, so we must have some basic ideas about the treasury bonds. So treasury is a separate thing from the bond. Bond itself is a very wide term, and it is studied across different semesters in undergraduation and then in post graduations also. So bond it is a fixed income security that the investors buy for kind of a fixed return that they are expecting every year. So treasury is a department that companies have. So treasury department is entrusted with a lot of responsibilities like issuing of bonds. And apart from issuing of bonds, treasury is also entrusted with the responsibility of investing into the bonds. So they deal with the cash inflows and outflows. So this cash inflows and outflows has direct impact over the profitability of any firm, because we already know once we start doing the valuation of the firm, so basically the valuation of a firm is dependent over the free cash flow. So again, that free cash flow is calculated based on the formula that we derive from the net operating profit after taxes. So all those financial terms will get involved in this research, from where I will try to see a relation between this forward rate agreement, that is the instrument that very soon I will be talking about, whether that has impacted over the profitability of the companies or not. Because in the recent past, we have seen that there are various kind of risk which has affected our international market, like so many crises have happened, right? In 2008 also, like there was a big crisis like Lehman Brothers. All the financial mechanism got failed. So thereafter, we started focusing towards have a mechanism that can actually establish a kind of basic foundation which can avoid the future risk that can happen with the any companies, right? So bond prices has a certain relation with the interest rate. Interest rate means the basic rates which we know about every countries, right? For interest rates are different for different countries. So what is the relation between bond prices and interest rate? So when interest rate fall, the prices of bond rises. Once the prices of bond rises, so whosoever has bought that bond, if that particular bond is in the portfolio of any company, the cash of that particular company rises. That means portfolio value will rise. So now when interest rate goes up, so consider this situation, when interest rate goes up, bond prices will fall. And once this bond prices will fall, the value of the fixed income investment will also fall. So this is the basic relation that one should have before diving into the forward rate agreements. So I will try to explain this through a timeline. Suppose this is the timeline, and if someone has bought a bond, and that particular bond is paying ₹60 every year, that is the fixed income everyone is getting after buying that bond. So that we consider as a coupon, right? So every year, if someone is getting ₹60 as a coupon, right? So what should be the fair price that that particular bond should trade? So that relation we calculate after discounting that future cash flows. What is the future cash flows here? The future cash flows are ₹60 that every year we are getting in the form of the coupons. So that price calculation will be done on the basis of counting all these future cash flows. So this is the formula of deriving the present value of that particular bond based on the future cash flows, right? If you very keenly observe here that there is the inverse relationship between the price and the interest rate, right? The interest rate is in the denominator, whereas the price is there in the numerator. So if rate increases, the price decreases. This is the simple relationship that I wanted to talk in my previous slide. Now, once we have established a relationship between the price and the interest rate, so of course the price of the bonds are totally dependent over the interest rate risk. Nobody knows that what is going to be interest after 6 months, right? Nobody knows that what is the interest is going to be after 1 year or 2 years down the line, right? So basically, once this relation was established, then parallelly another relation was established, and that relation was shown through yield curves. right? So bonds with longer maturities, like bonds, they trade in the market with different maturity times. Like few of the bonds, they have the maturity period of 1 to 2 years, but there are also bonds which have maturity dates that is more than like 7 years, 8 years, and some bonds are for 30 years also. So the bonds with longer maturities are more sensitive to a change in the market, that is the interest rate, right? And thus are more volatile in a changing rate environment. Conversely, bonds with the shorter maturity are less sensitive to changing rates and thus are less volatile in a changing rate environment. So this is a graph of the yield curve that you can see on the x-axis. This is the term that years I have plotted, and over y-axis, this is the yield rate that one investor can expect. So as we move towards the right of this particular graph, as the term increases, the yield a kind of it is becoming constant after 6 years, right? So this is happening because of the interest rate risk. Now, the introduction part of my research paper, the Treasury Department of the companies either issue that I have already talked that they are entrusted with the responsibility of issuing the bonds and investing into the bonds. So they are primarily focusing on ascertaining the cash inflows and outflows for the future, right? Because if they fail to ascertain and show this future cash inflows and outflows in the future, the company will certainly fail in their project appraisals, because based on the project appraisals, they are there to decide that which project would be beneficial for them. And once they are decided with the project, once they have selected the project, then they go and start investing into the project to earn more profit. So this particular interest rate risk from its origin itself plays a very vital role. If this particular risk is not hedged at the very initial level, then that can potentially become one of the potential reasons for the loss for the companies. And even in some cases that companies may go bankrupt. This has happened in the past. So the Treasury Department hence need a mechanism to ascertain its future cash inflows and cash outflows to become more confident in the project appraisal. So the companies, to hedge this interest rate risk, the companies use forward rate agreements to hedge interest rate risk. So now let's move on and understand what is this forward rate agreement is. So primarily in forward rate agreement, what happens, there are two parties. One is the banker and the other one is the customer of the banker. So if we talk about the company's perspective, suppose there is a company in India called SBI, and there would be some other custodian for SBI, right? So take the example of some other company, for example, SBI Life, that is the subsidiary of SBI, State Bank of India, right? So there would be some other custodian for this SBI Life. The custodian might be Deutsche Bank, Standard Chartered Bank, and Citibank, anyone. So this banker, this particular customer has the risk of interest rate in the future that could potentially decrease the value of their bond portfolio, right? So this banker's customer will reach to the bank and they will say that I am trying to fix the interest rate for the future. So whatever be the rate in the future, but I want to fix this rate today itself. So the banker will get into an agreement with this customer and they will get into an agreement. So that totally depends over the future now, that what is the interest rate at that particular time. If suppose in future this happens that the interest rate rises, then the customer will be benefited because his portfolio value will, which had decreased, get offsetted by this forward rate agreement. So whatever is the balance amount that will get transferred by the bank to this particular customer. So on this particular basis, this forward rate agreement works on, right? So now if we talk about the literature review towards my research paper, so I have studied two of the research papers that have worked on this particular field of forward rate agreement. So first one was by Augustinic and Bounderalt. They studied the mitigating interest rate risk in variable annuities. So again, they kind of developed a strategy to hedge this interest rate risk using the derivative instruments. So that particular literature review will certainly help in my studies to further see whether this particular FRA has impacted the profitability of the companies or not. Apart from that, the second literature review that I have studied is the interest rate risk management and the mix of fixed and floating rate debt. That was presented by Jaideep Oberoi. So this is again focusing on the interest rate risk. Like there should be a mechanism to hedge this particular kind of risk. So at the end, the research methodology of my research paper would be, I will be conducting a critical comparison among the companies that uses forward rate agreement and to that companies which do not use. So basically this will differentiate the potential of forward rate agreement towards the profitability of the companies. Apart from that, impact of forward rate agreement exposure on companies' profitability will also be corroborated by their financial statements. So a lot of data I'll be taking from the financial statements of the company. Like I'll be taking the data from the profit and loss statement and the balance sheets of different companies to assess whether this particular cash flows has impacted towards the profitability of the companies or not. Apart from that, the cash flow statement will also be seen. Hypothesis for my research would be this is my null hypothesis, that there's no impact of forward rate agreement on company's profitability, and the alternate hypothesis would be there is an impact of forward rate agreement on company's profitability. At the end, the conclusion would be it will be totally dependent over the studies and the hypothesis testing. So it will be critical to see if null hypothesis gets rejected or I fail to reject the null hypothesis. So this is all about my presentation. Thank you so much for giving me opportunity, and